In the second half of this lesson on credit cards, we're going to talk about interest calculations and credit card statements, and how you can understand what's going on with your credit cards. Okay, so by the end of this, you'll know how credit card interest is calculated, and you'll know how to read your statement. First of all, you got to understand that credit card companies charge interest and fees for any unpaid balance beyond your first statement date. If you bought something on the first of the month, you'll get your statement towards the end of the month, and if you can't pay the full balance, then they charge you interest and fees. Okay, so here's an example. Suppose you have unpaid balance of $1,000. The annual interest rate is 18%, which is a common percentage on credit cards. So first thing you got to figure out is, well, what's your monthly rate? Because they're doing this by month. 18% per year divided by 12 months in a year is 1.5% per month, right? 18 over 12 will give you 1.5. Okay, so notice this is 1.5%, but we're going to use a decimal number. So I move the decimal place over twice, and we'll get 0.015 here in a minute. All right, how you calculate interest is the same as we've done in other lessons, where it's the principal amount, or your balance, times the interest rate times the amount of time. Okay, so we're doing this monthly, so I'm using that interest rate. It would look like this. $1,000 is the balance. 0.015 is this percentage rate expressed as a decimal. Remember, move it twice to the left. And so 1.5 becomes 0.015 as a decimal number. This times this, that's a monthly rate, so I do it times 1 month, and I would get $15. Okay, quick way to tell is 1% of a number is take away 2 zeros and you get $10. So 1.5% of 10 would be, or if 1% is $10, then 1.5% is $15. You can do this without a calculator if you just are good with decimal points. Notice if I did this times 18% times 1/12 of a year, you would get the same number. Okay, that's how it's calculated. $15 doesn't seem like a lot, but here's the deal. Any unpaid interest charges are added to your balance, and then next month you pay interest on the interest. So you'd be paying this 1.5% next month, not on $1,000, but on 1,015. Oh, plus a $40 or $50 finance charge. So you'd actually be paying 1.5% on about $1,070 if this was another $60 or $55 or so. That adds up a lot. This situation compounds, and by compounds we mean it gets worse quickly. The same way that interest you earn if you're an investor, the way that interest compounds and can pile up money in your favor if you're earning interest. Here you're paying interest, so it can compound quickly. Be careful if you can't pay the full balance. Okay, another practice one here. Let's look at Christmas shopping. You had a bill of $500, don't have any cash to pay for it. Credit card charges you 12%. These rates are always annual unless stated otherwise. Okay, so what's the monthly rate? Well, 12% divided by 12 months. I think you can do the math. 1% per month, or 0.01 is decimal. What are the interest charges? Well, principal times interest times time. $500 times 1% times 1 month. Remember what I said? 1% is move the decimal 2 places over, and I get $5 for the first month. It doesn't seem like a lot, but remember, you're going to pay 40, 50, 60 bucks in a finance charge for just not paying off the whole balance. So be careful. If you can't pay off the balance, it spirals downward quickly for you. Okay, final example. $2,000 balance. They charge you 16%. Well, these numbers didn't come out so pretty. 16 divided by 12, that's 4/3, or 1.33, or 0.0133 is a decimal, right? I just moved the decimal over twice. That's all I do. And what are the interest charges? Well, principal times interest times time. $2,000 balance, 0.0133 times 1 month. I used a calculator on this one. I get $27. Again, doesn't sound like a lot, but you're paying finance charges, and then you'll get interest upon the interest, because most people don't have $2,000 sitting around. So be careful when you run up a debt on your credit card. You want to know what your statement says, and so here is a sample statement offered from the Federal Reserve, and they give you a lot of details here. First of all, they give you a summary of activity. You've got your previous balance here at the top from last month. Any payments you made, notice that the positive amounts are money that you're going to owe. The negative amounts, these ones with a minus in front, are one of only two things: payments you've made by sending them cash, or a transfer from your bank account, your savings account, or something like that. And you might get a credit. Other credits, this person had none, but if you had a return, you bought something on Visa card, you took it back, they put credit back on the account, you'd see a negative number here, which would drive down the amount you owe. Purchases, yeah, you got your balance plus new stuff you bought this month. Oh, plus you transferred a balance from something else for $785. That's a lot. Oh, you took out a cash advance. Oh my gosh, that's huge. Cash advances charge huge fees, and so here's your fees plus dollar amount, interest charge plus a dollar amount. So now you owe $1,786, despite the fact that you paid off 450 of this 535 balance from the last month. That's a lot. So this person only has $214 of credit left, okay, because that's 2,000 your credit limit minus the 1786, not much money left to spend. And so I better be careful. This is going to spiral downward quickly if you're not careful. Okay. Payment info. They give you the minimum payment here, but you are going to pay a lot of fees if you can't pay off that 1786 quickly. And most people can't. So be careful. Don't get that balance up too high to begin with. Part 3, they have to give you this information here, the late payment warning, just telling you that if you don't pay, you're going to get a lot of fees and your rates may be increased. If you don't pay off, guess what? Your interest rate goes up. Look at that. 29%, almost 30%. Okay? They have to give you a minimum payment warning. So if you only make the minimum payment, you're going to pay a long time. These two items, 3 and 4 on this sheet, these are the result of federal law which required credit card companies to give consumers these warnings because too many consumers didn't know what was happening with their credit card accounts. Even with these warnings, some people probably are making mistakes of getting into debt on credit cards, but a lot of people have done better because of these warnings. And these were not always in place. They've only been in place for a couple of years due to federal law because credit card companies were making so much money off of people's irresponsible financial habits. Okay, next slide. Let's look at this. Here we have changes to interest rate. They have to announce what happens here. Notice your APR, your interest rate, annual percentage rate goes up if you didn't pay. And so any transactions made before this date, you might have current rates, but they might change it. If you get 60 days past due, that's only 2 months. They'll change it for past purchases. That's crazy. Stuff you bought 60 days ago is now going to be charged a higher interest rate than the interest rate was when you bought it. That almost seems unfair. Well, guess what? It's in your contract. You've got to read your contract. Changes to account terms down here. They'll explain to you what these changes were. And again, these are mandated by federal law because so many people were losing so much money on these types of changes. Can you imagine if your boss all of a sudden said to you, oh, you know what, you're not working too well. I'm going to go back in time and I'm going to pay you less per hour for work you did 2 months ago. That's crazy. That's kind of like what this is, but it's totally legal. It's in their contract, so be careful. Pay the balance or your rate can go up. And so something you bought 2 months ago, you might pay much, much higher interest rates on that purchase if you're carrying that balance forward. None of these issues apply if you pay off your balance in full every month. All right, so read your contract. Call the company if something changes. Ask a lot of questions. All right, last statement here is your transaction history here, and this will tell you the reference number, it'll tell you the dates, and it'll tell you where you got it. It won't say something like store number 1. It'll actually say Target, or it'll say Fry's, or wherever you shopped at. Okay, Safeway, wherever you bought stuff. Okay, so these details will be there, and you can actually call a number and find out what the transaction was if you want to. All right, notice it's got the late fees and any balance transfers, all the total fees here for this period. They should have these detailed for you, and you can challenge those fees if you're a good customer. In most cases, you're going to pay them, but if you're a good customer, has a history of paying off your balance, those fees can sometimes be reversed because they know they're making a lot of money off many people. Okay. Section 9 is just this middle section, year-to-date totals. That's self-explanatory. Interest charges. This is what we just went over. Here's your annual interest rate. They take that, divide by 12, and multiply by the balance, and then you get a number real close to this interest charge. Notice that cash advances, a much higher interest rate on the cash advance. So you take that number, divide by 12, multiply by this number here, and you get a small fee, but this will add up quickly. This is just the interest. There are other fees for cash advances. Notice here, cash advance, 22%, about $5, $4.79, about $5 was just the interest. But up here, cash advance fee, they just charge you $10.90 just for doing it. On top of this $4.79, you're already paying about 15 bucks just to get $265. That's crazy. You're paying for your own money. Okay, well, actually, they're lending it to you, so that's not a safe statement. Either way, you want to understand your credit card statement. In summary, credit cards can be a tremendous resource, but they can also be very dangerous. There's a reason why there's all these signs out here about people being addicted to cards and how to get rid of your addiction. There's 12-step programs like the ones they have for alcoholics and for drug addicts. There's a reason for this. It's a lot like gambling for some people. They get hooked on it. They think it's fun. They can go buy stuff without any responsibility. It does catch up with you. Be careful. Keep yourself under control and maintain financial discipline. So credit cards aren't bad, but you've got to use them responsibly.